Welcome to the deep dive. Today we're opening up a file that feels a little different. It's less like your standard financial analysis and I don't know, more like discovering a secret map. A map that's been drawn by the real titans of finance, and it details their path to safety and to profit when the rest of the world is just, well, focused on market highs.
And I think it's so important that we frame this correctly for you, the listener. This isn't about some, wild market timing theory or political commentary.
Right.
This is about recognizing a mechanical, a century-old script. We're looking at the insider signal. When you really dig into financial history, before every single major systemic collapse.
Like 1929.
Exactly. 1929, the crash of '87, the housing crisis in 2008, the same three specific, highly tactical moves were made by the most sophisticated capital out there.
Okay.
These trades, they're the ultimate dividing line. They're what separates the financial victims, the people forced to sell in a panic, from the victors, the ones who not only survive but profit massively from the chaos.
And the loudest signal, the most just blatant siren flashing red that it seems like everyone is determined to ignore. While this rally just steams ahead, it's one single number.
Yeah.
Warren Buffett's holding company, Berkshire Hathaway, is currently sitting on a staggering $325 billion in cash.
Wow. It's a number that's hard to even get your head around.
It is. To put that in perspective, that is the largest cash hoard in the history of institutional investing. It's more than the GDP of entire countries, all just parked on the sidelines, unproductive, during a bull market.
And for anyone who follows Buffett, this position it's just so deeply contradictory to his whole philosophy.
Absolutely. He hates cash.
He famously dislikes holding cash. He calls it an asset that just, melts away with inflation. So when an investor of that scale, someone who's seen and profited from pretty much every economic cycle since the 1950s, when he chooses to park that monumental sum, that isn't a mistake.
No.
It's a calculated strategic declaration. It's a position. So the core question we really have to address for you is this. If the people with the deepest market data, the longest memory of these cycles, and the most sophisticated risk models are moving hundreds of billions to the sidelines, what are they preparing for?
What do they see that the rest of us are just cheering past?
Exactly.
So our mission today is to really analyze this billionaire crash playbook. And we're going to treat this sequence of events as you said, something predictable, almost a mathematical certainty. A script that functions less like a prediction and more like a mechanical law of nature. We're going to unpack the three critical trades that these institutional players execute before the crash to secure their position.
And then, crucially, we'll look forward to that fourth trade, the one that lets them execute a generational wealth transfer during the chaos.
We're basically giving you the map and pointing out exactly where the strongest players are right now.
The whole foundation of this playbook, it really boils down to one thing: pattern recognition. You see, crashes are rarely, if ever, these random acts of God or some sudden political shock. They're the inevitable result of predictable mechanical cycles. And they unwind when systemic leverage meets extreme valuation.
And that cycle is almost always the same, isn't it? It doesn't matter if it's the 20s or the 2000s.
It's identical. First, valuations reach these just unsustainable historic extremes, often driven by a handful of superstar stocks. Sound familiar?
A little bit.
Yeah. Second, leverage just saturates the entire system, from, consumer credit cards all the way up to complex derivatives. It makes the whole structure incredibly brittle. And then finally, when those two conditions are met, the insiders, the sophisticated money, they quietly begin their measured, systematic exit.
And it's fascinating how often the simplest signs are the clearest ones for those who choose to see the pattern. We always talk about Joseph Kennedy in 1929. The story, right, is that he started pulling his money out after getting stock tips from a shoeshine boy.
And people hear that and think it's just a cute story.
Right. A quaint anecdote, but it wasn't. It was Kennedy recognizing that final stage of irrational exuberance. The moment the public, the minnows are all in, they're fully invested and totally confident.
He just saw the script was ending. It was that simple. And it was the same with Paul Tudor Jones, who famously saw the leverage and valuation extremes building up before Black Monday in '87. He just saw the trajectory was unsustainable.
And he positioned for it.
He did.
Yeah.
And more recently, Michael Burry didn't have some magic crystal ball for the 2008 collapse. He did the work. He looked at the underlying mechanics of the mortgage-backed securities and realized the math was just wrong. The risk was completely understated.
So they weren't prophets. They were just, disciplined. They were the few who recognized the script existed and chose to act on it instead of following the herd.
That's it. And that brings us right to where we are now in what the source material calls the distribution phase.
And this is probably the most critical part for the average investor to understand, right? Because it's not obvious.
It's the opposite of obvious. The distribution phase is this extended period. It could be 12, 18 months, maybe even longer, where the whales, the institutions, the billionaires, they systematically and very, very quietly sell their holdings.
And who are they selling to?
They're selling to the minnows, to the late-stage retail investors who are pouring money in, fueled by momentum and that powerful fear of missing out right before the storm hits.
It's like the party is at its loudest. The indices are hitting all-time highs.
Exactly. But if you were a waiter in the room, you'd notice the hosts are already taking the good paintings off the walls and signaling to the security guards. And what makes right now so compelling is the synchronization of it all.
It's not just one data point.
Not at all.
No.
We were seeing the three core preparatory trades, the main elements of this playbook, all running at the same time, which confirms we are deep, deep in this distribution phase.
So we've got the really visible action, Buffett's giant cash hoard, that's trade one, cash conversion. Then we have the systemic risk hedge. Central banks around the world quietly buying up physical gold at record-breaking paces. That's trade two, the insurance policy. And then the offensive weapon is being loaded. These sophisticated hedge funds are piling into highly leveraged volatility bets, basically preparing to profit from the collapse itself. Trade three.
The synchronicity of those three distinct moves by the biggest players across three completely different asset classes, equities, currencies, derivatives, that is the insider signal.
They're all getting right.
They're all making highly defensive and highly offensive preparations simultaneously. And the source material really emphasizes a specific timeline warning here that you, the listener, you need to internalize. These foundational trades, the raising cash, the buying gold, they take time.
This isn't about tomorrow morning.
No, this is happening 12 to 18 months before the actual sharp crash event. This is about positioning for the next major cycle turn that the top tier is already pricing in.
And that timeline is so important for understanding the psychology of it, which we'll get into later. I mean, these big players, they have to move slowly, don't they? If Buffett tried to dump $325 billion of stock in a week,
He'd crash the market himself.
exactly, he'd destroy his own exit price. So their exit is this controlled, systematic process. It's designed to maximize their selling price by keeping the market looking strong and buoyant.
This current high market, which is so painful for people sitting in cash to watch, it's their exit window. That's the part that's hard to stomach. The time for defense is right now, precisely because this final phase of distribution is happening.
The strong hands need the weak hands to believe the party's never going to end.
That's it. The whales need the minnows to feel confident, to buy the dips, to chase those high-flying stocks. It creates the liquidity they need to get out at these inflated prices. It's a slow, methodical, purely mechanical transfer of risk, from the informed to the enthusiastic.
Okay, let's unpack this. This critical first trade, the foundation of the whole playbook, the great liquidation, or a cash conversion. The mechanical reason for this, it seems so simple but so profound. When the system freezes up, liquidity becomes oxygen.
It is. It's that simple. If you don't have unencumbered cash when the fire starts, you are forced to sell whatever you have at whatever price you can get. That's how fortunes are just wiped out.
So this trade, it basically signals the moment the big guys look at the market and just conclude that the math has stopped working.
Exactly. When market performance is being driven purely by, momentum, by speculation, by this sort of leveraged belief that the central banks will always be there to save the day, the fundamental defensive investor realizes their time is better spent preserving capital.
They're preparing to deploy it later.
They are. This is the act of converting paper wealth, your highly appreciated stocks, volatile tech, private equity, into real liquidity, guaranteed non-volatile cash.
And that cash, it serves two functions, right? First, it's a guaranteed survivor of that liquidity vacuum you mentioned, the air pocket where there are 100 sellers for every buyer. But second, and this is the crucial part, it's the only thing that lets you go on offense. It's what lets you buy up distressed assets later when everyone else is strapped.
Which is why Buffett's $325 billion isn't just a shield. It's an armored assault vehicle just waiting for the battle to start.
And we can see this insider exodus playing out I mean, in stunning detail. It goes way beyond just Buffett's hoard.
Oh yeah, the $325 billion is the loud siren, but the specific actions of these other insiders, those are the map markings. Buffett isn't just sitting on cash, he's actively selling. He's cut his massive long-held position in Apple significantly.
And he's dumping Bank of America.
Systematically. And that double action, getting out of both the top tech behemoth and a core financial player, that signals a really deep structural distrust of current valuations in the two sectors most exposed to a downturn.
But the selling, it goes even deeper. I mean, look at what the founders and CEOs are doing. Jeff Bezos, after he stepped down, sold an insane amount of Amazon stock. $13 billion.
Billion, yeah.
Mark Zuckerberg has been systematically liquidating his Meta stock. This isn't just, diversification. This is the guys who know these companies better than anyone on Earth, taking massive chips off the table at what they clearly see as a peak.
And if you want the most telling signal of all, the one that really points to structural anxiety, you have to look at finance. Jamie Dimon,
the CEO of JP Morgan Chase.
He sold his JP Morgan stock for the very first time in his entire career at the bank.
Wow.
Just think about the gravity of that. The CEO of one of the world's most systemically important banks, a guy who weathered 2008, who has unparalleled visibility into the global debt structure. He sold his own company's stock. It's during a rally.
That just screams that the internal data he's seeing, the risk models on his desk, are flashing dangers that the public market is completely ignoring.
It does. And this all raises that critical question, why? Why are they selling? It's because the fundamental math, the logic underpinning this market, has become statistically absurd.
These guys are driven by numbers, not by hype.
Exactly. And the numbers show we are in extreme territory. Let's just unpack this valuation trap using the metrics they watch. We can start with the CAM-P ratio, the cyclically adjusted price-to-earnings ratio.
Okay, so this isn't the standard PE. It's a longer-term view.
It is. It smooths out the noise by averaging earnings over the last 10 years,
Yep.
adjusted for inflation. And when you measure the S&P 500 by CAM-PE, it is currently trading at valuations that we have only seen twice before in history.
Don't tell me.
Immediately before the 1929 crash and at the absolute peak of the 2000 dot-com bubble.
Wow. So that's not just a warning sign, that's a binary signal. Every time we've hit this level, a generational collapse has followed.
Within 2 years. To put it in human terms, the market is pricing in decades of perfect, uninterrupted growth. It's assuming nothing can possibly go wrong, ever.
The definition of euphoria.
Total euphoria. Then you have the Buffett indicator itself. That's the total value of the U.S. stock market divided by the GDP, the gross domestic product.
So the market's value versus the actual economy's output.
Right. And historically, when that ratio is around 100%, the market is considered fairly valued. Right now, it's not just high. It is sitting at 2 standard deviations above its historical normal average.
2 standard deviations. So what does that mean in, plain English?
It means we are in the statistical 2.5% tail risk scenario. The market's value is just. It's become completely divorced from the nation's actual productive capacity. And the smart money understands that this kind of decoupling is mathematically unsustainable.
And this is all made worse by this intense concentration risk we have right now. The source material points out that the so-called Magnificent Seven, NVIDIA, Apple, Microsoft, and so on, they now make up something like 30% of the S&P 500's total value.
That's an incredible number. And that narrowness creates massive fragility if the growth story for just 1 or 2 of those companies breaks, say an unexpected earnings miss from NVIDIA that suggests the AI boom isn't growing to the moon, the entire market index is immediately threatened.
A systemic ripple effect.
Instantly. But honestly, the simplest calculation driving all this selling, trade number 1 is the purest form of financial arbitrage. It's the risk-free rate.
Okay.
When you can take your money, put it into a U.S. Treasury bond, and earn a guaranteed 5% return, a risk-free return that sets a baseline for every other investment you could possibly make.
It's the ultimate comparison. Why would a rational, disciplined investor pay, say, 50 times annual earnings for a volatile tech stock, accepting decades of risk to get their money back when they can get 5% guaranteed?
The math is just unequivocal. The institutional players see paying these inflated prices for stocks based on hope and momentum as a terrible bet. So they are systematically selling that hope to the retail investor who's still chasing the rally.
And they're converting those proceeds into guaranteed safety that's earning them 5% while they wait?
That's the mechanical, profit-driven logic behind the Great Liquidation. They are literally being paid 5% to wait for the fire sale. So if the billionaires successfully pull off trade number 1, They've got their cash. They're protected from the market crash risk. But history teaches them that survival is, well, it's only half the battle.
Hmm.
They then immediately have to confront the second, and arguably even larger risk, the government's inevitable response to that collapse, the so-called cure.
Okay, wait, I have to challenge that for a second. If you've got billions in cash, and that cash is earning a risk-free 5%, why isn't that enough? I mean, cash is notoriously a terrible long-term hedge against inflation.
That's the critical distinction, and it's exactly why Trade 2 exists. You are 100% right. The historical script is crystal clear on this. Whenever the financial system breaks, when the leverage snaps and a debt bubble pops, governments and central banks, they don't respond with prudence.
No, they respond with a fire hose of money.
An overwhelming fire hose. Liquidity, bailouts, money printing, what we now call quantitative easing. So your cash protects you against the crash, but gold protects you against the subsequent guaranteed inflation and devaluation that comes from the government's cure.
And we have some pretty stark historical examples of this, don't we? I mean, the most shocking one is probably 1933.
It's the perfect example. The '29 crash had happened, the Great Depression was raging. So President Franklin Roosevelt executed this massive intervention, Executive Order 6102.
Which made it illegal for U.S. citizens to hoard gold.
Right. But the real mechanical outcome, the part that matters for this playbook, came next. With the Gold Reserve Act of 1934, the government devalued the U.S. dollar against gold by 70%.
70%.
Overnight. The official price of gold was repegged from about $20 an ounce to $35 an ounce. So if you were holding dollars, your purchasing power was systematically slashed, a massive tax on your savings. But if you held gold, your wealth relative to the dollar instantly appreciated by 70%.
A direct surgical wealth transfer.
Facilitated entirely by the government's desperate attempt to reflate the economy by killing the currency.
And then if we fast forward to our era, 2008, the crisis hits, the Fed responds with round after round of unprecedented QE, printing trillions of dollars. What happened to gold then?
It was the exact same playbook. Gold just soared. It doubled from its pre-crisis level of under $800 an ounce to a peak of over $1,900 in just a few years.
Because sophisticated capital saw the writing on the wall.
They saw that the financial system was being saved at the direct expense of currency stability.
So if that's the playbook, what are the signals we're seeing for Trade 2 right now?
The picture is even clearer today. Because it's no longer just individual billionaires, it's sovereign nations executing this insurance policy. This is what we call the central bank signal.
Okay.
We are seeing central banks across the globe, and most notably China, Russia, India, but also countries in Eastern Europe like Poland, buying physical gold at the fastest, most consistent pace since 1967.
Wow. Since 1967. This isn't just, a small hedge. This is a geopolitical shift. It signals a fundamental distrust in the dollar-backed system.
That's the bigger story here. And to your question about why China and Russia specifically are hoarding gold, it's highly strategic. They are looking at the next inevitable debt bubble pop, the one that's going to dwarf 2008.
And they know the only response will be to print trillions more, sacrificing the dollar's value.
Exactly. So by accumulating gold, they're reducing their reliance on U.S. treasuries, on dollar-denominated assets, and they're fortifying their reserves with an asset that has zero counterparty risk. Gold isn't tied to the stability of the U.S. government or the Eurozone or any debt instrument.
It's the ultimate asset for preserving purchasing power when confidence in fiat currency starts to go away.
It is, which means this playbook hedges them against all the major outcomes. Trade 1, the cash, lets them survive the rapid deflationary crash and buy cheap assets.
And Trade 2, the gold, lets them preserve that wealth against the massive inflationary wave, the currency debasement, that always follows the government's cure.
They're protected against the market falling, and they're protected against the consequences of the central bank stepping in to stop the fall. It's a brilliant pincer movement.
Okay, so Trades 1 and 2 are defensive. They're about survival and preservation.
They ensure you survive and you maintain your purchasing power.
But trade number 3, this is pure offense. This is where the sophisticated investor uses, a tiny piece of their capital to generate the explosive liquidity they need for that final shopping spree.
This is the volatility bet. It's explicitly designed to profit geometrically from market destruction.
And this move is interesting because it happens much closer to the event, right? Like 6 to 12 months out. Why the tighter timeline compared to raising cash?
Because timing volatility is just far more expensive and frankly, more difficult than a slow liquidation.
Mm.
Trade 3 is about buying insurance on a house you're pretty sure is about to burn down. We're talking about highly leveraged derivatives. Put options, which profit when a stock or an index falls. VIX call options, which profit when market fear spikes. And even more complex things like credit default swaps, which profit from debt failures.
And you don't want to be paying the premium on that insurance for 5 years. You want to buy it right before the fire starts.
Exactly. Let's talk about the mechanics here, because this is how you get your head around the sheer scale of the profit. When you buy a put option, you pay a small premium for the right to sell an asset at a predetermined high price, even if the market price just tanks.
So if the market crashes, the value of that right to sell high just explodes.
It explodes. And similarly with the VIX, the volatility index or the fear index, it measures the market's expected volatility.
And the relationship is inverse, right? Market down, VIX up.
Inverse and exponential. If the S&P 500 drops 5% in a chaotic week, the VIX might not just go up 5%. It might spike 50% or 100% because fear is not a linear emotion.
Yeah.
And what makes this trade the profit engine is the leverage. That volatility spike means those options can increase by 1,000%, maybe even 5,000% in a really short period of intense selling.
This is the strategic genius of it. They don't have to risk half their capital on this.
Not at all. They only need to allocate a tiny fraction, say 1 to 3% of their entire portfolio to these instruments. And that small slice, if the volatility spike happens, can yield a 50-to-1 return on that capital.
They turn a modest insurance premium into billions of dollars of instant liquid profit.
Generated precisely the moment cash is needed most. And that liquid profit is absolutely essential to fund the final trade, the shopping spree. The playbook is designed to be self-funding. The wealth transfer is financed by the destruction itself.
And we have legends built on this exact bet. Jesse Livermore, the famous speculator, made his reputation and something like $100 million back in 1929 by aggressively shorting the market.
He understood the mechanics of panic.
Yeah.
Then there's Paul Tudor Jones in '87. He used puts to bet against the market and famously tripled his money during the Black Monday crash.
He just saw the trajectory was unsustainable.
He did. And then, of course, the icons of 2008, Michael Burry, John Paulson. They didn't bet on stocks. They used credit default swaps, which is basically insurance against those mortgage bonds defaulting.
So when the housing market collapsed, their insurance paid out billions.
Proving the strategy works no matter what the trigger is. Mortgages, tech, commercial real estate, it doesn't matter. The purpose of Trade 3 is purely utilitarian and aggressive. It creates a vast, instant, liquid pool of capital right at the moment of maximum chaos.
So when the market is down 50% and liquidity has vanished, when no one else has cash,
the investors who executed Trade 3 suddenly have incredible reserves from their volatility profits, on top of the cash they already saved in Trade 1.
They didn't just survive the drop. They built a financial bulldozer, fueled by the destruction. That is the true power of the volatility bet.
So we've established it. The 3 preparatory trades are happening. The cash is raised, the insurance is bought, the volatility bet is placed. The whole mechanical setup is complete.
Which brings us to the question that everyone always focuses on. What pulls the trigger? You used a great analogy earlier. You said the specific match doesn't matter. The forest is already dry.
And that's exactly it. When the system is this saturated with debt and valuations are this extreme, as the HPE and Buffett indicator prove, the specific catalyst is, to a large extent, irrelevant to the final outcome. The system is brittle.
In 1929, it was margin calls. In 2008, it was subprime mortgages resetting. So we need to look at the leverage cliffs that the source material points to for the current cycle, maybe accelerating into 2026.
And they all point back to that one fundamental theme, leverage breaking. The primary candidate that's often dismissed is the commercial real estate cliff. All those CRE loans that were taken out between, say, 2020 and 2022, when interest rates were basically zero, they're now set to mature and reset at today's much higher rates, maybe 6% or 7%. The sheer volume of debt that needs to be refinanced in the next 18 to 24 months is massive.
And the key mechanism is that a lot of these properties, especially office buildings, are now worth way less than the original loan amount, thanks to things like remote work.
Exactly. So when that loan resets at 6%, the property often doesn't generate enough income to cover the new payments. This forces mass defaults, which forces massive valuation drops, putting immense pressure on the regional banks holding all this debt.
Which brings us back to Trade 1. Buffett dumping Bank of America stock is a direct reflection of this looming crisis.
It is. Another huge technical candidate is the Japanese carry trade unwind. It's complex, but it involves trillions in global liquidity. Essentially, investors borrow very cheaply in Japanese yen because the Bank of Japan has kept rates near zero for years. They then take that borrowed yen and invest it in higher-yielding assets around the world, U.S. bonds, emerging markets, whatever, and they pocket the difference.
But what happens when the Bank of Japan finally raises rates?
The whole trade reverses. Instantly. Trillions of dollars of borrowed yen suddenly become expensive. Investors are forced to sell their global assets, U.S. stocks, bonds, and flood back into the yen to repay their loans. It causes a systemic selling pressure and a rapid withdrawal of global liquidity.
A shock that starts in Japan but hits everywhere.
Instantly. And of course, there's the existential risk to our concentrated market. A big earnings miss from a giant like NVIDIA. The whole rally is built on the idea that AI growth is infinite. If that narrative cracks, it shatters the core belief holding 30% of the market together.
But no matter the trigger, the underlying mechanism is always leverage breaking.
Always. And once that trigger is pulled, it starts what we call the mechanical freefall, a sudden cascade that turns a sell-off into a crash.
First, the high-frequency trading algorithms trigger vast automated sell orders. They sell instantly based on price breaks, not on value.
Then those sharp drops trigger margin calls across the whole system. Anyone who used borrowed money is forced to liquidate their holdings to meet collateral requirements. This creates a relentless, accelerating cycle of forced selling.
And this is where the huge growth in passive investing like index funds and ETFs makes things worse.
It pours gasoline on the fire. These funds have to track the index. When the index drops, they don't analyze the quality of a company. They just sell blindly into the void to maintain their mandate. This creates that liquidity air pocket.
Prices free fall because liquidity vanishes. There are no buyers left.
Except for the billionaires who prepared, who raised their cash in Trade 1. And that leads us to the ultimate goal of the entire playbook, the implicit fourth trade, buying the fire sale.
This is the culmination, the moment of generational wealth transfer. When asset prices are suddenly 50, 70, maybe even 90% off their highs, the strong hands deploy their capital.
They systematically deploy the cash from Trade 1 and the explosive volatility gains from Trade 3. This is when fortunes are really made. Joseph Kennedy bought up huge tracts of real estate in New York and Boston in 1933 for pennies on the dollar.
Buffett bought Goldman Sachs at the peak of the 2008 panic with incredible terms. Bill Ackman deployed billions into beaten-down stocks in March 2020 when the COVID panic hit.
The verdict is clear. This mechanical playbook facilitates a systemic wealth transfer. Assets move from the weak hands, the ones who are fully invested, chase momentum, and were forced to sell in a panic, to the strong hands, who followed the script. They don't just survive. They buy up the best assets from the distressed sellers at extraordinary discounts.
Okay, so this entire playbook, when you lay it out mechanically like this, it's logical. It's historically undeniable. It's systematically profitable. And yet, we know that the vast majority of investors, even professionals, will fail to execute it. Which brings us to the core conflict, doesn't it? Following this mechanical law versus succumbing to that overwhelming, agonizing, emotional fear.
The fear of missing out. FOMO.
Yeah.
This is the highest hurdle. This playbook requires you to raise a lot of cash and just sit on your hands. To be disciplined and defensive while the market is consistently hitting all-time highs. That is an excruciating psychological trial.
It's brutal. When the headlines are screaming about the Magnificent Seven, when your neighbor tells you they doubled their money in AI stocks, and you're sitting in a savings account earning a modest 5%, the pressure to just give up and jump back in is immense.
The current market is almost designed to punish discipline. And many fund managers who get judged every quarter against the index, they fear underperforming that index far more than they fear a catastrophic crash.
So they'd rather risk getting wiped out eventually than risk looking wrong for 12 or 18 months by sitting on cash while the party is still going.
It's that acceptance of short-term pain that's the defining difference. The billionaires, they trust the mechanical law of the cycle more than the fleeting euphoria of the chart. They accept watching the market go up without them. They accept what looks like losing today for the long-term certainty of survival and that ultimate geometric profit from Trade 4.
They understand that sitting on cash isn't a failure to invest. It's a calculated position. It's the prerequisite for the next most profitable trade.
That's it.
So what does this all mean for you, the listener? Someone trying to replicate this without billions in capital. We have to emphasize it's about replicating the defensive posture, not perfectly timing the VIX.
Exactly. You don't need to short NVIDIA, but you must adopt the fundamental life-saving defensive posture of Trade 1 and Trade 2.
So we've tried to distill this playbook into 4 actionable pillars for the retail investor. Number 1 is simple.
Raise cash. Build a war chest. This is replicating Trade 1. You have to systematically take profits now. Even if you feel like you're missing out on the last 5% gain, do not be 100% in stocks. If you have no cash, you have no billets for the crash.
Aim for a significant allocation, 20 to 40% in high-yield, short-term things like T-bills or a good savings account. That cash is your oxygen, earning you 5% while you wait.
A second. Own insurance. A 5–10% allocation. This is your version of Trade 2. Allocate a small but meaningful portion of your portfolio to assets with no counterparty risk. This protects you against that government-induced currency devaluation.
So physical gold or maybe high-quality Bitcoin holdings, this is a pure preservation strategy,
Yeah.
hedging against the post-crash inflation bomb.
Third, hedge, or wait, this is the modified Trade 3. For most people, complex options are just too risky. So if you're very sophisticated, you might look at a simple inverse ETF. But for the average investor, the best strategy is just to survive. Don't panic sell your core holdings during the drop. The goal is to survive the volatility so you can execute the final trade.
And finally, the most intellectually rewarding step, the one that takes preparation and courage. Number 4.
Prepare the buy list. This is your execution of Trade 4. The biggest mistake people make is being paralyzed by fear when the crash actually happens. You need to know today exactly what high-quality companies, what undervalued sectors you want to buy.
Have the list ready, have the cash prepared, and have the courage to act mechanically, not emotionally, when the headlines are screaming catastrophe and assets are on sale for 50% off.
You have to preset your price targets before the market starts to fall. That's what turns a scary emergency into the predictable generational opportunity that the billionaires are all waiting for. So to reiterate the central theme of this deep dive, the mechanical pattern is repeating. The statistical extremes in valuation, the concentration risk, the systemic leverage, it all confirms that this mechanical law is nearing its fulfillment. And the insiders, the ones with the biggest fortunes and the best data, have already signaled their exit. They're executing the 3 core preparatory trades: cash, gold, and the volatility bet.
So the choice for you right now, it isn't about timing the exact peak. It's fundamentally a choice between preparation and vulnerability. You have to execute the defensive trades now, raise the cash, get the insurance to ensure you survive the drop.
Because you had to survive the drop to enjoy the rise.
And this entire predictable process, as we've said, facilitates a massive mechanical transfer of wealth from the unprepared to the prepared. Which leaves us with a final provocative thought for you to consider as you look at your own portfolio. Is this system inherently rigged or unfair? That the wealthiest profit most aggressively when the general economy and the average investor suffer the most agonizing losses?
Or is it simply the logical, objective reward for recognizing and following a predictable mechanical law of preparedness? A law that demands exceptional discipline and the willingness to accept short-term ridicule for the certainty of long-term geometric wealth creation. What steps, based on this historical script, will you take to prepare your portfolio right now?